Welcome to a special episode of CP Newswatch. I'm Assistant Business Editor Michelle Zedikian. The Bank of Canada is heading into its last interest rate announcement of the year on Wednesday. It's been an interesting time for the central bank as it navigates the pace of its interest rate cuts with the state of the economy and now with a little side of Trump politics. Joining me now from Ottawa to talk about the announcement and the implications is reporter Nojoud Al Mallees. Hi, Nojoud.
Hi.
Let's start off with what economists are generally expecting to see from the bank on Wednesday. It's likely a rate cut, but are we looking at a quarter percentage point or a half point cut?
So forecasters are now leaning towards a half point rate cut, and that's because of Friday's job report that showed the unemployment rate rose to 6.8%, up from 6.5% in October. And that really shifted expectations in financial markets as well towards a larger rate cut. It would be the second 50 basis point cut from the Bank of Canada in a row.
And inflation is back at the Bank of Canada's 2% target now. Is the bank still concerned about price growth?
Well, they're not necessarily overly concerned about high inflation. They're concerned about maintaining inflation at 2%. And so, the governor, Tiff Macklem, has said multiple times that he's both concerned about factors that could drive inflation lower than 2%, as well as factors that could drive it above 2%. And so now, as the bank often says, it's really all about sticking the landing for them.
It's the bank's last meeting for 2024 this week, but what about next year? Are rate cuts expected to continue?
That is the case. So Wednesday will be likely the fifth consecutive interest rate cut from the Bank of Canada, and we expect more rate cuts in 2025. So right now, the Bank of Canada's policy interest rate is at 3.75%. And what the bank calls the neutral range, which is the interest rate range where interest rates are neither constraining economic growth or promoting economic growth, is somewhere between 2.25 and 3.25%. And so the expectation is rate cuts will continue until we're somewhere in the middle of that zone.
With borrowing costs expected to continue falling, I guess that would be welcomed by many in the real estate market. Does that mean we could see a further recovery in housing?
So yes, the expectation right now is that 2025 will bring about more activity in the housing market. This year has been a little slower than previously expected. There were some worries that interest rate cuts would lead to a massive acceleration in the housing market in the spring. We didn't see that. But now that interest rates are already down quite a bit and more rate cuts are coming, and generally cuts have been faster than previously expected, right now, economists are expecting that we will see a rebound next year. Home buyers right now, or prospective home buyers, maybe putting off that decision until they see where rates settle down.
We've had a shakeup in US politics with Donald Trump returning to the White House. He's promised a lot of policies geared toward kicking the US economy into high gear. What's the tie into Canada and how that could affect Canadian interest rates?
Well, there's concerns that if Donald Trump brings in tariffs, it could lead to higher inflation. And just generally, if we see a real, as you said, kick up in the economy in the US, that could force the Federal Reserve to be even more cautious with interest rates. We already are diverging in Canada from the US when it comes to interest rates, and it's been at the expense of the Canadian dollar. And so it'll be interesting to see how the Bank of Canada continues to manage this divergence with the US. So far, Governor Tiff Macklem has been adamant that, he could run his own monetary policy while acknowledging there are limits to how much they can diverge. But we'll have to wait for 2025.
You mentioned the Canadian dollar. It's been trading at a multi-year low, around 71 cents US. What does this mean for the loonie?
I was speaking to an economist recently who said that we're really at the tipping point where a larger divergence could plunge the loonie below 70 cents, which would mean that buying things from the US will be more expensive for Canadians. And so, like I said previously, this divergence is really going to put more pressure on the Canadian dollar. And at some point, that could become something the Bank of Canada takes note of and influences their decisions.
Okay, thanks so much for the insights, Najud.
Thanks, Michelle.
That was Nojoud Al Mallees in Ottawa. We'll see what happens on Wednesday at 9:45 a.m. Eastern, and the Canadian press will have full coverage as soon as the announcement happens. I'm Michelle Zedekian in Toronto.
Thanks for listening. Don't forget to follow and subscribe. For more of today's top stories, visit thecanadianpressnews.ca.